Good day, everybody. Thank you very much for listening. My name is Abrie Grobler, and I'll be discussing when we forget to ask how much. So to start it off, when we buy consumables, we typically look for value. We want to buy something that's a bit cheaper than the next shop. Think, for example, at like a Discount 2-for-1 special, want to buy a bit more shower gel that's at a deal or something like that. Especially also more expensive stuff like a pair of shoes. Think about that time where you bought a pair of expensive shoes, walk past another shop within an hour, and you see that that exact same pair of shoes was marked down by 30%. We immediately felt like we paid too much for this pair, and we feel a sense of remorse, we feel a sense of regret because we paid too much. The same goes for when we buy more expensive assets. When we move to houses or cars, we negotiate a bit more. We go even further. We go to multiple dealerships if we're going to buy a car to see who can get us the best deal, who can put on some more extras on our model that we prefer. We go to a bank and negotiate an interest rate. We go to multiple banks and negotiate an interest rate. And the same goes for when we buy a house. We typically try and offer less than what the listed price is. We also negotiate and scrutinize banks for just a few basis points less because it's quite a long-term investment. So we want to make sure that we're paying the right price. So something different actually starts happening when we start investing our capital, especially in listed instruments such as equities. This phenomenon arises quite a lot. Is when prices start increasing, we're actually more drawn to these investments. So when these assets become more expensive, let's say a stock starts rallying by 40%, all of a sudden we're more drawn to this. We want to know what's happening with regards to this company and why is it rallying. And all of a sudden there's a sense of fear of missing out starting to form. And we actually want to buy these listed assets when they actually become more expensive, which is very contradictory of what we've just seen with regards to consumables, cars, and our primary home. On the other hand, when investments become cheaper and prices decline, we want to stay as far away as possible. We want to run for the hills. We want to take our money and put it on a mattress. And what's actually happening is that the price of that investment, or to get into that investment, is now a lot cheaper than what it was, but we would like to avoid it rather. So just a few examples of this phenomenon. What you can see over here is the top side, or the blue graph, is the stock price, and then the bottom side, the bar chart, is the volumes, the amount of shares that was traded in a day. What's interesting about the cannabis stocks back in 2017, 2018, is as the stock price increased, a lot more interest was gained in the stock. So a lot more of the stock was traded at that time. And this is typically agrees to what we said at the first point, is when asset prices actually increase, a lot of people are more interested to get their money in. So is this behavior normal? So why, when we buy consumables, we're bargain hunting? Why, when we buy cars, are we bargain hunting, and houses? But when we invest and prices increase, we're very interested and we want to get in as soon as possible. And the answer is it is actually very normal. All of us introduce biases into our decision-making process, especially when it comes to investments. And there are two main types of biases, or categories of biases, that we introduce. The first category is called cognitive errors. This is statistical or information processing errors that result in faulty reasoning and analysis, and it can be easily corrected if one is made aware of those. Examples of biases within this category include confirmation bias. This is where people tend to look and notice for everything that confirms their beliefs and ignore everything that contradicts their beliefs. So instead of having a debate about the facts, we just listen to everything that confirms what we believe in. The second one of the cognitive biases is hindsight bias. This is also very easily explained. I'm sure a lot of you read articles and recently that stated how predictable COVID was if you just listened to the signs or looked at the signs that happened in December, and then looking in hindsight, we could have avoided quite a lot. So, as they say, hindsight is an exact science. So that is hindsight bias. I'm sure a lot of us experience this. The second main category of biases that we introduce are called emotional biases. These are harder to correct because they originate from impulse or intuition rather than conscious calculations. So examples of these include loss aversion bias, where the emotion we experience when going through a loss in the value of an asset is much more intense than the joy that we get from experiencing a gain in an asset. And then we get overconfidence bias. Now, I'm sure a lot of you went to a braai on a Saturday and you had a family member or a friend explaining with complete confidence how he or she would be the ideal Springbok coach and that the coach should just listen to them because they know how to coach rugby and the Springboks. So that is clear explanation of how we overestimate our ability and we don't look at the facts. So I'm going to stand still at loss aversion. So loss aversion was first written about by Kahneman and Tversky back in 1979. It's basically the premise is that losses loom larger than gains. So it is thought that the pain of losing is psychologically about twice as powerful as the pleasure of gaining. So what happened later was that Richard Thaler, a Nobel Prize winning economist, went further and developed a further definition of this called myopic loss aversion, or exaggerated on the fact back in 1997. Myopic loss aversion is defined as when an investor takes a view on their investments that's largely focused on the short term. This leads them to react too negatively to recent losses, which may be at the expense of long-term benefits. Think about the time that we've heard news about a certain stock, and all of a sudden we want to make an impulsive reaction because of that news. We didn't take a step back to think whether or not this is realistic, whether or not this fits into our goals, fits into our plan. We just reacted out of one news article that could be a rumor, that could be fake news for that matter. So it's a very emotional reaction, and we immediately want action. So just an example of how myopic loss aversion actually can occur is back in June, Kodak announced that they will be pivoting into generic drug manufacturing, or that they filed for a patent to manufacture generic drugs or the ingredient for them. And the stock price increased by 1,600% in a matter of days. This is an example of where short-term information causes us to make a decision immediately. It can be very irrational in retrospect. So just looking at the graph, yet again, the graph in the blue at the top is the stock price. The bottom yellow graph is the volumes traded. So what we can see over there is that stock price increased significantly over 2 days. Like I said, by 1,300%, increasing all the way to $35 a stock. Needless to say, if you were one of those latecomers and you invested 2 days later, you might have made a significant loss. That stock price decreased to $15, so that's more than a 60% loss that you actually made. And yet again, to reiterate the fact of our previous example, just have a look at how those volumes traded in the stock increased as soon as the asset price started increasing. So a lot more interest once this asset actually got more expensive. So what can we do to avoid this? What can we do to avoid experiencing myopic loss aversion, or loss aversion for that matter? Because when we experience these biases, it causes us to trade quite excessively. When we trade excessively, we incur quite a lot of costs. These costs include anything from the realization of losses, as well as limiting the gains, transaction costs, as well as opportunity costs. And if we allow these costs to incur on a frequent basis, we actually allow these costs to compound over time. Just as we want our investments to compound, these costs can also compound over time. And what we're actually doing is that instead of creating wealth, we're actually destroying wealth. So because these biases are emotional in nature, it's impossible to make the experience of losses seem less painful. There's also no guidebook to teach us how to control our emotions, or to limit the effects of these emotions, or to limit our impulses. We can be more disciplined in our approach, however. We can ask ourselves a few questions before we act on emotion or we act on impulse. First question I would ask is, am I making a speculative decision based on opinions, or am I making an informed decision based on facts? Just to take that step back and ask yourself whether or not it's factual in nature, or if it's driven by fear, could already maybe prevent you from making a very wealth destructive decision. Also, the second one I would ask is, what's the narrative that's driving the stock price? What's the narrative that's actually driving the fear surrounding the asset, or the optimism surrounding the asset? If we understand the story behind this movement in the price, we can also make a more rational decision. And then thirdly, is there any way to quantify the fear or optimism that's being priced in? If we can have a numerical example, or a numerical value for the value at risk, for example, or the value that can be lost, we can also take, yet again, understand what we're letting ourselves in for, and we can make a decision from there. So just to summarize our presentation, the power of compounding can either lead us to wealth creation or wealth destruction. So when we pay too much for consumables, a car or even a house, we immediately experience a sense of buyer's remorse. However, when we invest our capital and buy assets, we want to buy more when these assets become expensive, especially stocks. And the question is why? The main reason behind it is because all of us experience emotional biases that are not easy to correct. We should take a step back and just ask ourselves if we are reacting on an emotional impulse that we're experiencing, or actually are we reacting on facts, and did we think this decision through. Mange explains that the first rule of compounding is never to interrupt it unnecessarily. So, as Taylor said, we should rather avoid myopic loss aversion than to react on short-term facts that can actually influence our long-term welfare. We should thus allow our savings and investments to work for us and not against us, and not allow these errors that we experience when we are emotional in nature to compound against us. So I'll leave you with this last quote from Charlie Munger. He says that understanding both the power of compound interest and the difficulty of getting it is the heart and soul of understanding a lot of things. That's all from my side. Thank you for taking the time, and thank you very much for watching and listening. Please feel free to contact our offices via telephone or email. More than welcome to go visit our website. And please follow us on Twitter. That Twitter handle is @PSG Pretoria Oos.